Good afternoon. Renaissance Services welcomes all of you to the investors and analysts meeting of the company. On behalf of the company, thank you all for being here. Please switch off your phones to avoid any interruption. If you have any question, please raise your hand and we will reach you with a microphone. And now, Renaissance Services CEO, Mr. Stephen Thomas, will start the meeting. Thank you.
Very good afternoon, everyone. Thank you once again for your interest and support by being here. We have all the right people here to answer your questions and other colleagues as well from the management team in the room. But I have Mr. René Kofod-Olsen, the CEO of Topaz, Vishal Goenka, the CFO of Renaissance, and Jay Dagger, the CFO of Topaz here as well. So we open the floor to your questions. Who would like to ask the first question?
Yeah, thank you for meeting us, because we met almost one and a half months before. I think it's a pleasure to meet you again, and I have a follow-up to my previous questions. I think one is on because we met in February, how we are in March, and how the situation, how your performance, how do you see that? You might have got more indications in terms of the overall performance. Oil price is also more stable now, at least in the range of 65 to 70, which René was mentioning, which is a very, very comfortable level. And people are looking at CapEx. How do you see that? That's my first question. And the second question is on your Tengiz. What's the status on that? Because Tengiz, again, in terms of, I think Vishal and Jay can explain more. Because we are finding out the deal is very attractive deal, but in terms of the cash flow, how this because we are not able to understand how the cash flow generation for the company on this deal. Because EBITDA is there, you're pre-funded with those things, and we want to know the real cash flow impact of this Tengiz deal and to the shareholders. I think that's what we want to understand on this, and this is what my question. Thank you.
Well, thank you very much. I'll take the first part of the first question and pass the same question to René, and then René will also take the Tengiz question. First of all, how is the year going as we're nearly at the end of the first quarter? You'll understand that we won't give a specific forward-looking statement. You've not got long to wait, but we do have to wait for all those actual reportings to come in from all the companies and all the countries, but that is happening. I think the year is starting very much as we described it in that last meeting about 40 days ago. The oil price, we can see, is remaining stable as we felt it would, although we can't predict, obviously, volatility in oil price. But we did say that what would come back first would be more activity in the businesses rather than increased rates or value. But the year has started well, as we expected. We knew that there would be continuing challenges for the OSV industry. Certainly was expected in the first half of the year, and René can update on that. The two big issues, you've asked Tengiz already, and René will answer that question specifically. The other big issue for us in the services business will be occupancy in Duqm. That's about 3% higher than when we last met, as it was expected to move up slowly. Remember we told you that we're looking at the average for the year to be about 53%, so north of the 46% break-even mark, and significantly higher than the 11% of the 11 months of 2017, 11 operational months for that project. So we're on track for that. We're expecting the big issue is the EPC contractors and their subcontractors from Duqm Refinery, and the timing of that. So we know they're all awarded, the 3 packages. We have very positive dialogue and relationship with every single one of those EPC contractors. We have a clear picture of what occupancy they're expecting, and whilst we are working on the final sort of sign-off on those deals, so it's not a closed issue. I can tell you that it's extremely positive dialogue with every single EPC contractor and their intentions. There's some issues on demand demographic of the types of rooms, so there's some changes we're going to make sure that we can accommodate all. But that is looking very positive. We also have a sign-off with the UK military, who are working closely with the Oman military in a joint Safe Syria exercise at the end of the year, and that is already committed to give us additional occupancy in Duqm as the year progresses. So will that occupancy move when we first expected it in April? I think there'll be a little bit of delay. You know, Refinery are talking about groundbreaking ceremony at the end of April, so I think notice to proceed will follow shortly. But our overall prognosis for the year in that side of the business is positive, and it's got off to a good start. We've also had some, whilst I don't want to mention client names until we get permissions, but and it's not a sort of contract that we'd answer because it's an established major contract that we have in the oil fields. We have won again and been extended for a further 2 years. That was one of our must-wins at the start of the year. So very positive from that point of view. And if you remember, we said, don't get overexcited. We're expecting step change each quarter. So this first quarter, whilst we can't make a direct prediction, we certainly expect to be better than Q4 of last year, and then each of the quarters coming is still on track to be a steady climb up to restored profitability. René, on the OSV side, and then Cengiz.
Yeah, thank you very much, Stephen. So we have continuously seen that constructive marketplace in terms of CapEx being deployed in the global market. Certainly in our core markets, being the Middle East, Africa, and Caspian, they all have shallow water sort of dimensions, and the extraction costs for the oil majors are relatively lower than what you see in some of the deeper markets. Oil price have kept stable as we predicted. I believe I mentioned that if we can have an oil price between 60 and 70, that is a very good level for oil majors to reinvest in their depleted fields. We are seeing that. And we are seeing budgets being approved by oil majors. We are seeing contracts being negotiated with oil majors. So the predictions of a steady transformational 2018 in our core business holds water, to stay in a maritime comment. And we will see even more constructive marketplace in 19 and 20, as we can see the pipeline for the oil majors actually increasing right now. The direct link to the OSV market for us is that there is about 30% of the global fleet in layup. This has been the deepest crisis ever seen in our industry. Very few people, very few companies are left standing. And so 30 to 35% of the global tonnage, so the global amount of vessels, has been in layup now for the third, for some the fourth year, coming into 18. Now, I have described before that that's like an old car. You put it in the garage, but you don't take it out and it will start again. So a lot of these vessels will need immense surgery for them coming back into a fighting standard. And in most cases, this will mean that it is actually more money being spent on a vessel compared to the actual value of the vessel. So we expect to see a lot of the surplus tonnage we saw in 14 actually automatically getting out of the market as we get through 18 to scrapping and basically writing off assets. We are seeing that playing out as we speak. That means that if those 1,000 vessels or 1,500 vessels is not coming back into the market, you will start seeing a normalization of the market. That will drive utilization upwards, and that will, of course, also drive revenue. That's what we are seeing playing out now. It has to be allowed to play out in 2018, but 19 and 20, I will dare the skin and say we are more bullish on 19 and 20, and 2018 is, as predicted, going to be the transformational year for the industry. In terms of Tengiz, which have always been a part of our discussions here, then this is by any stretch of imagination a transformational project for Topaz. We embarked on a journey of differentiation some 3-4 years ago, where we had the ambition to be more than a vessel owner. We wanted to attract marine logistics solutions, to never get caught up being a commoditized player in an industry that so easily historically has been commoditized. So we looked at not necessarily what the oil majors would want us to service them, but what they need us to service them with. And thereby came the Tengiz project. We designed a brand new vessel, and we are building 20 of these vessels right now. The contract, as you ask, was negotiated in a way that it was a pre-funded contract with the main parties of this project. And why was it a pre-funded? This is with the super majors of the industry. Their cost of capital is completely different than a normal company of our size. So it was a natural decision for them on the back of this $37 billion project for the Chevron and their partners to actually include a pre-funding of these vessels, because the cost of funding for them was so much less than what a normal company like ourselves could attract. So that became part of the negotiation. So these vessels are the property of Topaz. We have agreed for the fixed duration of the contract not to undertake any financing on them, as they're pre-funded over the contract. So they are full equity for the company. They have recently been independently evaluated by one of the biggest brokers in Norway at a value that exceeds the cost of purchase. So that's very positive for the company. The cash value of the contract is not 100%, of course, hence the pre-funded nature of this contract. But I have before been sort of segmenting how the cash flows are operating. So we do expect anywhere between $50 and $70 million of pure cash over the fixed period. And bear in mind that at the end of the fixed period, you will have 17 vessels. We operate 20 vessels, but 17 vessels is the property of Topaz. Will be the property of Topaz unencumbered in our balance sheet. So there's a huge equity value for the company in these vessels. And mind you, they are attractive in any global shallow river system, and they are deployable in the entire Caspian Basin based on the way they have been built. We have deployed the first two. So when I talked about this project last year, it was a concept. Now we have actually sailed the first two, and they broke the record of transit in both river systems by half. So what we had aspired to deliver in terms of efficiency for our client, we have delivered and actually sort of doubled the efficiency that is norm on those rivers. Now that's disruption, and it's nice to be part of it. The concept has been proven, the vessels are now being delivered, and we expect all the vessels to be fully deployed as we pass over to the second half of this year. Mind bearing that we can only sail vessels when the ice is free in those two channels. But we already accumulate cash flow from the two vessels that are operating, and drip-wise, as we take delivery of the remaining vessels, they will go full hire. So at the turn into the second half, all vessels will be deployed. It was a long answer, but it's an important big project for the company.
Eventually, you're talking about $50 to $70 million as a cash value.
So that's what we see right now. We of course have a very prudent CFO, two of them, and so it's very important that we are also ensuring that we we can actually deliver the services that we have been asked to render, but also that we are paying the taxes that are due to us and so on in the jurisdictions that we are working in. But it is our prediction right now that this is the minimum cash that we can derive from this in the fixed period. Remember that we have optional periods subsequently. So the numbers that I have given you here and that I have reported before is the 1,095 days fixed only.
Okay. And which means your deleveraging is, what is your, because your other businesses are probably, the deleveraging will make sense in
the
this?
Deleveraging is significant.
Yeah.
What you have to bear in mind is that, without being an accountant here, then EBITDA is EBITDA.
Yeah.
And our debt is based on our ability to accumulate EBITDA. Whether it's a cash EBITDA or it's an accounting EBITDA, it is an EBITDA that is a strength for the company. So whether you get the cash or you get the equity of your EBITDA, it counts the same. So by the end of this year, we will have added a significant amount of EBITDA to our portfolio, and so we expect our net leverage to be significantly reduced, close to 4, if not below.
Okay. Thank you.
Just to add, we have today 13 vessels delivered, and 3 of them are fully functional, and remainder are waiting for. So within next 4 to 8 weeks, we're going to pretty much complete the delivery of all the, other than maybe 1 or 2 that will go into later part of second quarter.
Hi, thank you, gentlemen, for the presentation and your time. I just have a question on your Dukum village. Under a blue sky scenario, let's say that your occupancy would be 100%. So what kind of revenue are you expecting and the kind of EBITDA margin? So there's just a lot of working required from on our side, so it would be more easier for you, to get some sort of flavor to that. My second question is on your pack business. How do you see the inflationary pressure in Oman impacting your cost side? So what kind of impact it will be having this year or maybe in the short term?
So in terms of the Dukum facility, what would we expect if we were at 100%? And I think it is reasonable to expect occupancy to be 100% in 2019, 2020, assuming that the refinery does start on time. There are different scenarios depending on the actual demand demographic, singles, doubles, fours, etc. But overall, the performance you could expect to mirror at top line the same as we have collectively over our Renaissance villages across the oil fields, so a top line of 30 million. You've heard that our break even is 46%. The bottom line, the PAT from that would be in the region of about 7 million riyals. Again, it will depend on the actual mix, and of course you can take out of that the depreciation of the 75 million riyal investment over approximately 25 years as an average on that. So those are guideline numbers. They will be different. We are seeing quite interesting trends of additional revenues that we can generate inside and outside the fence with our customers there. So I'm really giving you what we see as the base case performance numbers that we'd see from that.
My second part was on the inflationary pressure. Are you seeing any kind of inflationary pressure this year?
Yeah. There is inflationary pressure, and it comes from a variety of areas. So, for example, where we have approximately 60% omanization across the Renaissance villages in the oil fields. There is an automatic 3% increase in the salary level. We've seen, both of which things we're quite delighted about, by the way, and we're working on increasing that percentage of above the 60%. We've seen pressure on utility prices, utilities that we draw from our client, PDO, etc., that has gone up, as well as the sort of general inflation that you see in food inflation, consumable inflation, etc. And it is some years now since we've increased our rates in the Renaissance villages, and we're working hard, even in spite of that inflation, not to increase the rates going forward over the next couple of years, unless there was some extraordinary event that would affect the whole market. Because we're recognizing with all the clients in oil fields, and the same work that our Topaz colleagues do, is we're trying to make sure that we give our clients more for less. So when I describe those inflationary pressures, I can see you quite rightly thinking, well, then we can expect a decrease in the profitability of those facilities. And actually what we have seen over the same period that we've been absorbing those additional costs is we have managed to increase our profitability, not by great margins, but nevertheless we've increased year on year. So how does that happen? And that has happened through a number of initiatives that we've taken away from the site. The facilities we've built in Marbella for our central stores, looking at direct importation, working with local suppliers to try and increase our in-country value spend of goods and services where we don't compromise on safety, on speed, on time, or on price, and actually where we look to shorten the supply line to drive down our costs but increase their profits in terms of what can be done. So whilst that isn't a bottomless pit, the way I must commend my colleagues in our procurement, in our finance, in our operations who are working on these issues every day, and our HR, they've managed to really drive efficiency into the organization. And the longer we can sustain that, we will not be passing on the inflationary pressure to our clients. And it's where we try and bring together, dovetail our entire sustainability agenda. So it is about operating safely. That's a very efficient, cost-effective way to operate, as well as the correct way to operate. It is about growing efficiently with some of those savings I'm talking about. It is about delivering locally with the supply line and planning green. And in all of those areas, while some of them seem like cost pressure areas, we've actually managed to drive down our cost. Just on the planning green, we've driven down our utility costs, we've driven down our carbon footprint, we've driven down our food waste. So although there is inflationary pressure, your company here is working hard on outperforming the inflation by the way that we operate and grow.
Thank you, gentlemen, for the presentation. I have a few questions. One is on the Topaz consolidation opportunities that we have mentioned in the annual report. How do you see the events getting unfolded over the course of the year or next 2 years? And what are the opportunities that we might be interested in looking at? And are we actively pursuing any opportunities as of now? And if there are any, how are we planning to fund it? The second one is on the Renaissance services. We have around $150 million contract which were due for renewal. That is mentioning about Ministry of Health and BP. What's the status of it? Can you paint some color on that? If you can do that, that would be appreciated. Then on the CapEx, what is your CapEx guidance for the next 2 to 3 years from a modeling perspective? And if we have spent close to around 85 million in last 2 years, a total of around 170 million. So what is it going to be going forward for the next 2 to 3 years, and how are we planning to fund it? On the Tengiz contract, I just wanted to clarify certain things. You have mentioned about the icing in the river. So will there be any seasonality in the revenue, or is it like the flat $25,000 per vessel average per day? Or will there be a seasonality, like on the 1st of April, we will have our ships getting ready, or once the ice is gone, ships will be start sailing? So will it be the same next year as well? Or will we see some ups and downs in the ups in third quarter or fourth quarter, and then some downward pressure in the first quarter? And wanted to confirm on the depreciation side, we have this vessels getting in 3 years, but are we going to depreciate it over 15 plus years? Just wanted to confirm on that, or is there any accelerated depreciation? The last question is on the IFRS policy implementation impacts. Like we have IFRS 9, IFRS 15, and IFRS 16. I think IFRS 16, correct me if I'm wrong, it will be more impacting on your Tengiz contract. That's my assumption. Will there be any impact on that for the modeling, from the modeling perspective? Thank you.
Okay, yeah, definitely. That was a lot of Topaz questions. I'll see if I recall adequately all your good questions. So first was the Topaz sort of opportunities for consolidation, as we have talked about. So there has been many over the last 3 years, and our view has been that unless we are absolutely sure that a merger will create shareholder value, then it is not a risk worth pursuing. So it's sort of like catching a knife that falls. You can cut yourself on both sides. I think that has been prudent in terms of not doing anything. I do also believe that now we are in a transformational year, as I have described, and so would we be amenable to participate in consolidation in the future? The answer is yes. We will be looking at that. We would do it with the same predicament that we do not want to import risk that is not completely calculated. We want to do this to create shareholder value and be living up to the role of one of the leaders in this industry. I believe, as I'm sitting here in front of you today, pound for pound, we are probably the largest offshore company in the world today. Nobody has a backlog like we do. Nobody has a cash flow generation like we do. So that's positive. So we are seen as one of the leaders of the industry, and therefore, should there be opportunities to create additional shareholders' value, we would certainly look at that. You asked about funding of that. As I mentioned to your colleague, we expect to be lower geared by the end of this year, but we would not do any merger that would be counterintuitive to importation of risk. That means that we do not want to enhance our leverage further than we have today. So clearly, it has to be a measured consolidation should we participate in it. Then you ask if there was any live ongoing discussions. The answer is no. It doesn't mean that there's not a lot of interest in the company. We're very humbled by that, but we do not have any engagements as I sit here in front of you. In terms of the capex, we have 120 vessels today, and we are spending between $15 and $20 million of maintenance capex a year. That's what you can model. Then there will be years where it is 15, maybe even below, and there will be years where it is 20, depending on the cycle of the ships. They go through a 2-year and a 5-year cycle. So that is how you can model. We don't have any unfunded, that has not been disclosed, unfunded CapEx coming in. We have 2 subsea replacement vessels coming in end of this year. Part of it has already been paid, and we have 10-year funding on those 2 assets. They're part of our fleet renewal strategy. And then we had 1 vessel that was outstanding coming into the crisis. We have skillfully replaced that big anchor handler with 2 smaller anchor handlers that are diesel electric and the newest standards coming in over the middle of this year. Part of the funding of those vessels will be divesting other older vessels. So we are by the end of the year not adding any leverage to the expected leverage that I was explaining to your colleague here. In terms of the tankers contract, I'm pleased with your question, because this was one of the very big negotiation items and one of the key ambitions that we had as a company was to de-risk the sort of the contract in its length, and therefore seasonality. So therefore there are no seasonalities for us. We have a day rate that has been negotiated per day, 365 days a year. So you will not see the seasonality in that contract. We do have seasonality in the Caspian Sea because of the ice. So the first quarter is always subdued slightly in Caspian because of ice. And that will then level out over the year. Hence also my colleague Stephen's comment that first half second half will be better than first half. Part of that is seasonality, but the tankers contract is a full 365-day contract, so that risk has been taken completely out. You then asked about depreciation, and therefore we went to the global markets and asked for an appreciation of the assets to ensure that we were doing the right thing accounting-wise. We also took an advice from Deloitte. These vessels are, by any stretch of imagination, the same kind of vessels that we normally would buy in terms of their workability over a long period. So they will have a working life between 25 and 30 years. We have, however, decided to depreciate them over 15. Yeah. Did I remember all
Thanks
the
very
questions?
much, Randy. Well, the IFRS one we're going to throw at Jay in a minute, so you're okay on that. I'm giving him ample warning, so while I answer the bit in the middle. You'd asked a couple of questions on the services business, specifically on contracts like BP and on Ministry of Health. On BP, we have retained our EWC work, the EWC camp. We have won the new developments with them for KOB Kazan Operating Base and KRC Kazan Residential Complex. So this keeps us in the Kazan field with BP for the next 2 years. And I do believe that whilst obviously we're a very respected group of competitors working in the business, the nature of and complexity of the mobilization and requirements of that, I do believe that we have serious opportunity to be a long-term tenant and partner with that client, and the degree of satisfaction that they have expressed in the services provided by my colleagues there. In the Ministry of Health, we're still waiting for the response. I can tell you what is available in the public domain in terms of published tender results, where it is very clear. We are the incumbent today of 85% of all the services provided across the Ministry of Health hospitals. We are the incumbent in every major hospital in the Ministry of Health portfolio across the land. We're also in the Armed Forces Hospital, that's a separate contract. Looking at the published tender opening results, we are cautiously optimistic that we will be retaining or increasing our 85% holding of that business, and by increasing it could be a substantial increase on that. Of course, that decision is a matter that rests with the Ministry of Health and it rests with the tender board, and we respectfully wait the outcome of that. But we, our commercial team and our operations team have put us seriously in danger of winning a major award there, let's put it that way. You asked about CapEx, and for us, we've just completed the largest single CapEx investment in the company's lifespan, the 75 million real investment in Duqm. We don't have a similar major plan. We do have something that we are tabling to our Duqm boards and to the Renaissance board, that we may consider a 4.5 million expansion of that facility to maximize the potential of what we can do with the EPC contracts and the Duqm refinery. That we already have covered and planned in terms of our existing capability and what we would ask the shareholders of the Duqm entities to step up with in terms of equity in that. And we've had those preliminary discussions with them and what the financing would be of that, because it's not a major amount for us to deal with, the 4.5 million. Generally, we spend around 3 million reals a year reinvesting in the integrity of our existing assets and making sure that they are well maintained and kept up to speed, and renewing different elements, ACs or whatever it might be. We don't have currently a further major investment target right now. What we envisage, obviously we are anticipating generating significantly larger cash flows with the improved performance that we've seen coming at the end of last year and into this year. Significant new cash surpluses coming from the increasing occupancy at Duqm. And at the moment, our priorities, we are well on target and clearly able to meet all our obligations, including repayment obligations when they're planned. We understand what has gone on, particularly through these last 3 very difficult years that we've experienced in the oil industry. We want to get back to returning dividends to our shareholders, and we anticipate that we would be looking perhaps at some M&A activity in the region, probably about 9 months to 12 months after Duqm getting to full occupancy. But there's no specific plan in that regard. We constantly remain on the lookout for opportunities like Duqm, like the Renaissance villages, 1 or 2 that we're looking at where there may be a different propco, a property owner that isn't us, but that we operate, but bring the know-how to the project. Others that, as with Duqm, where we've taken just over 50% of the equity in the property and 100% of the operation. So we continue to look at those opportunities going forward, but none specifically planned at the moment in terms of CapEx. And the IFRS question, Jay.
Yeah, our auditors have reviewed the impact of IFRS 9, 15 and 16. And since we own all the assets ourselves, so there is no risk on us to reclassify our asset. In fact, the risk is on our customers, who have chartered these vessels from us on a long-term basis. Now, for a TCO contract, there is specifically they have included a clause in their contract which makes it as a service contract and not vessel-specific contract, which probably gives them the permit not to take these assets in their books and recognize the liabilities. There could be one implication, and that would be positive to the company, that the advance which we have received from the customer and the benefit of that advance may need to go to the revenue and finance cost. So to that extent, probably our EBITDA, the book EBITDA would increase. But however, we are looking at the possibility of keeping our books as simple as we can. But we are in very, very close dialogue with the Deloitte. The bottom line is that we are not expecting any impact of these IFRS because we own all our assets and there is no chartered in vessel in our books requiring us to capitalize those in our books and take the liability.
And is there any fresh loans envisaged during the course of, let's say, next 2 years? Another question that I have is, I've noticed Renaissance has prepaid most of its 2018 loan repayment obligations. Why was that? And how much is our repayment obligations for the next 2 years?
Sure. I'm the architect of what turned into a brilliant move to prepay, is Vishal, so I'm going to let him answer that question, the prepay.
Thank you, Joyce. And that's where our banks love us, yeah? Because in these oily times, everybody is drawing more and more, and this is a company which made losses for last 3 years and saying that, yeah, we will prepay you, yeah? So that suggests that how strong is our cash flow model and why we prepaid, to give a message to the banks that we are, our business model is intact, cash flow is coming in from our PDO villages, from our Caspian fleet, and no need to worry. Whatever is happening is basically from impairment and some of geographies, those will turn around. The prepayment was also that, if you don't have that a investment program where you can generate immediate return, it is important to deleverage your balance sheet. And that is our commitment to our banks and our shareholders, showing that ultimately we are going to deleverage. When you look at our debt to EBITDA now, it is around above 6 times, but it is going to be around 4, at a group level. So cash, if it is available and you can not deploy in the business because there is no any immediate investment program, because we don't want to do any speculative capex at this point of time. So why don't we give money to the banks? They are happy, all covenants you meet, and they feel very confident. With this process, what happens when you need money next year, the same banks will come and give it back to you, because that's where you made all your commitments in the most difficult period of time. So that is on the prepayment, yeah? So, of course, sometimes banks don't love us, don't like this prepayment, and because, if you're returning their money, you're returning the business, but they really value this, and that worked very well for us. And that's the reason you are seeing that we were able to refi every time whenever we wanted, and we have very good long-term loans, good tenure. Next year, our repayment at a group level is 14 million Real Omani. And if you see our balance sheet of 31st December, the cash balance is 50 million Real Omani, yeah? So basically, we are all at rest, no need to worry, that anxiety is not there. This anxiety was there at the start of the crisis. But then what you can do, you can't control oil price, yeah? What you can control discussion with the banks, financing, how you put all those structure, that's what management did. So 14 year, we will be able to pay, no issues. Next year, almost a similar kind of, repayment. In terms of drawdown, of course, as Topaz CEO mentioned, that we are working on this subsea vessels, so there would be some drawdown. Already we have tied up the loan with HSBC, so there is no issue, no any uncertainty there. So our leverage will come under control once you will start seeing our EBITDA growth in 2018 and moving forward. So we will keep prepaying. We will, whenever we will find the right opportunity, because yield curve is just going to go up, correct? You are seeing what's happening. So we are not going to wait that interest rate just goes up, and at that time you start the discussion on the prepayment. You prepay at the right time. And that really helped us in 2017.
Just to confirm, 2018 is 18 million. Is that right?
Yeah, so between 14 to 18 million.
And
correct.
2019 is
Almost the similar, slightly higher it will go up because your Dukkam repayment will start, but it is not significant. It would be around 24 million real money.
24. Okay, 24. And 2020, is there any major repayment?
Yeah, so
balloon
again,
balloon?
it is going to go up by 4 million real again. Yeah, not more than that.
Thank you.
Thanks, Joyce.
Just to follow up from what Joyce has asked, how you're planning to go with the Standard Chartered equity? Are you planning for further equity raise, or would you go for debt to, pay off the liability? And another question is on your cash side. The the amount you got from the Tangier Share Oil, the advance amount, how you are accounting it? Is it a part of the cash, or is it a separate escrow account? Can you just elaborate on that as well?
So for Standard Chartered, they invested in the company in 2014, and I think we've discussed it over the years here. As you know, we are very close, and as my colleague Vishal have just mentioned, we are always very, very close to our financial ecosystem, and that is the same with Standard Chartered Private Equity. They came in initially on a 3-year mandate. It was clear that this company has always been pegged for a liquidity event, and so they came in on that mandate. Then life happened to everybody, and we did the prudent thing of going back to them and saying, listen, it is the right thing to renegotiate this and find an amenable outcome. I think it was a fantastic craftsmanship that came out of that, so we gave Standard Chartered Private Equity a little bit more holding, and in return, the carry or the redemption price was reduced significantly to 8%, and it was a 5-year instrument. So dating back to the time where they came into the company. So that was a very positive negotiation, and so it is clear that the company is still, whether it be consolidation, the company's stated ambition is still to eventually stand on its own feet. And when the time is right, that liquidity event will certainly be back on the table for the best outcome for all shareholders. And so Standard Chartered has come in now on a 5-year, potentially with an extra year on the horizon. So we don't have to hurry. We have to do the right thing for all shareholders. The reason that I would like to remind everybody, the reason why the choice fell on Standard Chartered Private Equity, because we had a lot of interest in the company from global private equity companies that is only doing private equity. But why was it Standard Chartered Private Equity that the decision fell on was that they also have been next to the company for many, many years on the balance sheet side of life. And so if you can say Standard Chartered Bank's cousins over in Standard Chartered Private Equity, it was a known commodity. And they would only invest in companies that they had a relationship with on the balance sheet side. So therefore, we picked the probably more patient capital. And so it is my personal opinion that we don't have any pressure of getting an exit for an exit. We have the pressure of finding the best shareholders return for all shareholders in Topaz. Now, is that going to be indefinite? Absolutely not. There is nothing that is indefinite in this life. So we still have time. It was a 5-year plus an additional year should that be necessary. So we still have 2 or 3 years to solve that.
Yeah, and to answer to your second questions, the money, the advance which we received from Tangier Share Oil has gone to construct those ships. So there is nothing in the balance sheet as escrow account. All the advance is sitting in our balance sheet as advance from customer, and the contract to that advance from customer is the capital work in progress or the fixed assets.
Yeah, I just pass a comment on the stand chart thing because Rene will be and Jay will be a little modest because they negotiated on those deals. And I know all this we declared, and at the time of both events, the initial 9.8% when they came in for the guaranteed 12% and 3-year horizon for the liquidity event. When that changed against the realities of the market, and they renegotiated to the 8%, which of course backdated to the beginning of the whole thing. So it's 8% across the thing for the additional 3.7% in shareholding. This demonstrates, okay, there was the value of the $75 million coming into the company, so increasing the size of the company. We weren't selling our asset. We still owned 100% of the asset we had. But it's actually been also, I think what Rene's touching on there, a great relationship. We've ended up with a really quality shareholder who works very hand in glove, you know, with our senior representatives on the Topaz board and everything. So it's whilst it's been tough for them because of when it happened, I think it's still going to prove to be a big part of the solution of whenever that event does happen, and they have the patience for it, and that's what happened in the renegotiation of that deal. And full credit to Rene and Jay for making those deals happen. Thank you.
In the chairman's report, we haven't completely ruled out the possibility of any further provisions, despite the market getting stabilized and most of the provisions being taken. Why is that, and what would be this? What would be the circumstances that might lead to any further provisions on the vessels? If you can just paint some color on that.
So I believe you talk about impairment. You speak about impairment,
yes.
So this is, we have spoken about that before in here, and this is the unfortunate thing of a mathematical model that on these vessels. So it's very clear that the vessel value follows the given market. There is a willing buyer and a willing seller, and that is being measured once a year by reputed brokers. And we have, of course, also done that in these 3 years. This became very aggravated based on the basically landslide crisis that we went into over the last 3 years. It's unprecedented. And as I mentioned, 30 to 40% of the global fleet are in layup and not used. That put a tremendous pressure on vessel owners, and therefore values have, of course, gone over a cliff. We have done the I would say constructive housekeeping over the last 3 years, and very, very diligently with the broker that is evaluating, which is always a reputed international broker, and our auditor. In the last couple of years, it has been Deloitte. So we look at the value in use and, of course, the cash flows that are being produced on the vessels. We also did that in the years before the crisis, because you could argue, so why didn't we do any impairments before the crisis? We did very minor, but we had a very young fleet, as you may recall. We still have a very young fleet. So the value in use were always higher for those periods as the market was normal and balanced. Then we went into this crisis. Now, predicting on the current situation, well, if I look at the whole fleet, that will be our incumbent fleet during this year, I think we have done a lot of positive housekeeping. Can I 100% rule out that we are not going to look at individual vessels and providing for those? I cannot 100% rule that out, but it is my prediction that we have done a lot of constructive housekeeping over the last 3 years, and that our fleet of assets currently seems to be very marked to current value in use. But as I also said on the other questions, there is nothing that is completely definite in this life, but it is my best opinion that we have been one of the vessel owners that has taken this very very seriously and very constructively.
And Rene, can you just elaborate on what's the outlook, the market?
Yeah.
Is there any possibility of further,
Yes.
further contracts coming up? And the number of vessels that are in cold stacked right now, and
Yes.
how many vessels are expected to be in the water again? And the vessels that you said will be retiring in this year, how many of them are there?
Yeah.
And are they fully depreciated, or are they fully impairment provisions has been taken on all those aspects?
Very good. I will definitely do that. So let's start with the market. I believe I have touched somewhat on that with your colleague asking the question, but I will add some further color on that. I believe we are very well positioned in the business that we are in the markets that we are in. We are seeing our commercial funnel really increasing, as I have reported before. We stayed and slugged it out in Africa. It was very difficult, but we believed in the in-country value that we as a group are creating in the markets that we enter into. So the best word of describing it is actually that we continued and we slugged it out. Currently, we are 100% deployed in Africa. So we are having some formidable contracts with Exxon and Chevron in Nigeria, and we are very pleased with the fact that we have actually broken into that market based on super major clients. In the Middle East, we are very highly deployed in the 80s. We see a lot of development in the Gulf, and we believe that we are very well placed to participate in that development. We are expanding in both the UAE and in Saudi Aramco. We've recently extended our contracts over there in line with the contracts. So that is also very positively. In the Caspian this year, there is a lot of projects that are in between. So there will be periods where all vessels will be fully deployed, and there will be periods where 3 or 4 vessels will not be deployed. But in principle, this is an underutilized market, and in 2019, we actually believe that we have to take more vessels into the Caspian Sea. Our contract in Turkmenistan, we now have all vessels fully deployed, and I actually met with the people in Dragon Oil the other day, and they were very constructive on their further ambitions in that country. So bottom line is that the fear that shale oil in US would bridge all gaps in the energy demand of the world, I think that has been proven wrong. I think the scaremongering that has happened over the last 3 years has proven as well to be incorrect, and so we are faced with about $1 to $1.5 trillion of lacked investment in the energy sector. 1 to 1.5 trillion. Somebody even goes beyond 2. That hasn't been found. So you have a world growth that is going on almost steroids, at least if you ask some presidents of this world. And so the world growth today is funneled by energy. Renewable energy cannot deliver that. So you need fossil fuel for the foreseeable future, and we are well placed to participate in that. So I think that the underinvestment is coming back now. You see a lot of oil majors deploying capital now beyond their dividend program to reinvest in their businesses. Granted, all of them also need to have a position on renewables, but I repeat, there are very, very little energy today that is actually being covered by renewable. It is low single digit. So therefore, there is a lot of reason to be constructively optimistic on the trading conditions for oil and gas offshore companies in the future. Also mind-bearing that 80% of this beautiful planet is water. So I am, as a custodian of this company, Topaz, very optimistic on our place in the industry and in the industry as a whole.
Okay, and the number of vessels that are being stacked up, cold stacked?
So we have 5 vessels now remaining. At the peak, we had 12. We now have 5 vessels that are stacked. None of those 5 will come back and work. So they are part of our impaired fleet. We are now seeking to divest them. They will likely end their life in a scrapyard, where they can then be used to other industries in the future, hopefully. So that is the team is busy handling. There may be minor impairments depending on how we manage to get out of that, but it will be insignificant. We are selling a big cable layer that has been marked for sale over the last 12 months. It finished its contract in the North Sea. And that is now going to be divested. We are in the final days of signing that contract. So that's the current outlook.
Thank you very much. And two more questions from me. That's basically on, one is on the treasury shares. You have around 35 million treasury shares or 6.8 million reals worth of treasury shares at the cost. Is there any plan for divesting that treasury shares, or what's the strategy of the company with those treasury shares? And the next question is on the perpetual notes. Is there any plan for refinancing it, or we are approaching within the next 29 months, we will be approaching the first interest rate set date. So what is our strategy, or is it too early to think about it? Thank you very much.
I think Vishal, both on treasury shares and perpetual notes, will answer both of those.
Thanks, Joyce. Treasury shares are our hidden reserve, correct? So you see based on how share price is moving up and moved from 100 paisa to 300 paisa, 50 paisa, your value of treasury shares have gone up, correct? And that's the value that is not being reflected in the balance sheet, because you really carry treasury shares at cost. Now, the idea is that whenever you want to go for a phenomenal expansion program, yeah, you have this equity in place, you can always raise equity against those treasury shares. So that will depend on if we are doing another $300 million expansion plan anywhere in the world. Yeah, so that is reserve, provides a lot of solid equity base to your company. Second is like in terms of the market size where we are in, almost 10% of capital of a company of Renaissance, yeah, you are giving to any strategic investor, there will be a lot of premium, yeah. So that's where I'm saying that it is a hidden reserve, will always be used for future expansion of the company, for a strategic growth. That's the answer. And on perpetual notes, these are perpetual in nature. So we don't have any pressure to basically really go and buy those back. But if we don't buy those back after 2 years, then of course the coupon will go up. And considering our growth plans and EBITDA improvement and everything, instead of going for higher coupon, we will look at after 2 years at much lower coupon than what we are paying. Yeah. So perpetual notes will be refinanced before that or will be bought back, and we will have good internal accruals. Our leverage will come down significantly. That will allow us to buy back those perpetual notes from our Omani investors, because primarily they invested with us. And so you buy back, you refinance, so many options will open it up once your EBITDA will start improving from Tengiz and from Dukkha.
Well, in the absence of any further hands going up, my own prediction that you guys would have nothing to ask because we were here just 40 days ago is completely wrong. You've asked us some great questions, as always. And so on that note, from all of us in the company, thank you again for your continued support and interest in us. And we look forward to a good 2018 together. Thank you.